All right, so we want to talk about the first part of this chapter, chapter 9. And so let's do that. And so after you measure inventory, things might happen that cause the inventory to be worth less than its cost. And so when that happens, and GAAP requires this, management at the end of each reporting period must compare the cost of the inventory with its value, and if value is less, they've got to reduce it to the lesser of the cost or the value. And so we'll talk about how we figure out that value here. So there's two approaches to this inventory write down. One is called the lower of cost or net realizable value, and you use that when you're using a inventory cost flow assumption other than LIFO or retail inventory method. So FIFO, average cost, or any other method besides LIFO or retail inventory method, you use this lower of cost or net realizable value. If it's LIFO or retail value inventory method, you use lower of cost or market. And you may have studied this in financial accounting, but believe me, it's a little more involved than what you may have learned in BA 211. And so, as it says, the approach chosen by a company depends on which inventory costing method it uses. The financial statement effects are the same. The difference is the amount of the inventory write down. So for the lower of cost or net realizable value is the estimated selling price less any cost of completion, disposal, and transportation involved with such sale. And so it's the net amount the company expects to receive, not just the estimated selling price. And so at the end of the year, the company compares the cost of its ending inventory to its inventory's net realizable value. They have three options here. Well, before we get to that, if the net realizable value is lower than cost, the adjusting entry is needed. You reduce inventory from its already recorded cost to the lower net realizable value. Now, the three ways you can do this, and again, if the cost is lower than NRV, no adjusting entry is needed. So you can do this by the following methods. You can compare each individual item of inventory, meaning each category of the types of inventories. You could do it by categories of inventories, or you can do it by total inventories. And so here you have an example where if you do it by individual items, you simply take, in this example, all the items in inventory A and compare cost to net realizable value. Here, cost is less than net realizable value, so you take the cost, not the net realizable value. So it's the lower of the two. For inventory B, cost is above NRV, so you take the lower of the two, NRV being $90,000. You continue on with the separate items of inventory. Inventory C, here NRV is less than cost, so you take the lower being the NRV of 75,000. D, NRV is lower, so 85,000. And E, cost is lower, so you take that number, 95,000. And so you just total those up, and what you come up with is 395,000. Well, that's lower than the cost of all those individual items, which is in the first column, cost. So here you're going to have to have a write down of $20,000 if you do this LCNRV by individual items. If you do it by categories, you would here the categories are total of A and B, and then total of C, D, and E. If you do it that way, then cost for total A and B is lower than NRV, so you take that, 150,000. And then C, D, and E, the lower of the two, is NRV, 256,000. And you add those two numbers up, you come up with 406,000, which is lower than the cost, 415,000. So in this case, you'd have a write down in inventory of 9,000. And then if you do it by total inventory, it's exactly the same, and no. And where did you come up with this number? Well, NRV, total NRV is 431,000, and compare that with the total inventory cost of 415,000. And since the total cost is less than total NRV, you take the lower of the two, which is cost, 415,000. So that's how you came up with that number. So you would have no write down in that case. Now, depending on how often you do this, determines how your journal entry is made. So let's look at that. If it's pretty common, you're simply going to debit cost of goods sold and credit inventory. If the write down is pretty uncommon, you're going to have something called the loss on write down of inventory debit, and of course your credit still is going to be to inventory. Well, why do you do it when it's uncommon? Why do you do it that second way? I think probably to make it known. This loss on write down of inventory is a little more notable and obvious than just simply the adjustment to cost of goods sold. All right, so here we have following information pertaining to one item of inventory of the Forge Company. Cost is $270 for this one item of inventory. Replacement cost is $225. The selling price is $292. The cost to sell is $52. And so the question here, applying lower of cost or net realizable value, This item should be valued at what? Well, the item here in this that you should know is irrelevant is the replacement cost. Again, for LCNRV, the net realizable value is the selling price less cost of the sale. And so you take the selling price here of 292 less this cost to sell of 52, and you come up with 240, which is less than the cost. So this item should be valued at B. Now we'll see where this replacement cost comes into play when we're doing the actual lower of cost or market. Now notice a couple of things about LCNRV. Whether you do this LCNRV by individual items or by category or by total inventory, each approach is acceptable. Once you pick an approach, you should apply it consistently from one period to another. Well, what happens if after you make your adjustment, lowering it to LCNRV, what happens if you have an increase in the value of those items? Well, you don't do anything, so you cannot reverse the situation. You just keep it at the LCNRV. All right, so let's talk about lower of cost or market. Here, market means net realizable value, which has a different meaning than probably what you learned, if you remember, way back when. Market for LCM purposes is the replacement cost, the current replacement cost, except that the market should not be greater than the net realizable value. And so the net realizable value, which we just talked about, is the ceiling also. The market shall not be below net realizable value minus normal profit margin. And so you have to figure out what that is, and that would be your floor. And so you're going to have, at the end of the day, you're going to have the ceiling, which is net realizable value. You're going to have the cost of a replacement, which is the definition of market. And then you're going to have your floor, which is NRV minus a normal profit margin. And the number that you're going to compare to cost is whatever the middle range would be, whatever the middle number would be between the three. And so let me show you how that works. First, you have to figure out your selling price, because that's, from that you figure out your NRV. So here they have 5 items. They figure out the selling price less estimated selling costs. So selling price minus estimated selling costs is going to equal the third column, which is your NRV. That creates your ceiling. And then from the NRV, you take out normal profit margin. In this particular instance, it's 20% of the selling price. And so for each one of these items, that gets deducted from the NRV. And so the NRV minus the normal profit margin creates the floor, which is this last column. So you're going to transfer over to this next page that we're going to look at here following. The ceiling and the floor, and you're going to have also your market in the middle, and you're going to compare all three. So that's what we have here. In the second column, you have your cost. And so your replacement cost is your market. And you're going to compare that number with NRV in column 3 and NRV minus NPM, net profit margin, in 4. And whichever of the three is the middle number in all three of these is the number you pick as being market. So in this, for item A, you have replacement cost of $55,000. You have NRV of $85,000, and you have NRV minus NPM of $65,000. Well, the middle number of those three is the NRV minus NPM, so that's the number you pick for your market. You compare the 65,000 with the cost. Since the cost is lower than the market for item A, then that's the number you pick, 50,000. Item B, cost is 100,000. Replacement cost is 97,000. NRV is 90,000. NRV minus NPM is 66. So the middle number being NRV, that's the number that you compare with cost. Here, the NRV, which is your market for item B, you compare that with the cost, and the market of 90,000 is lower than the cost of 100,000, so that's the number you pick for that. For item C, cost is 80,000. Here, of your three numbers, your replacement cost is the one in the middle for 70,000. So that's the number you pick for your market. You compare that with cost. It's 70,000 compared to cost of 80,000. So you pick 70,000 as being your LCM. D, cost is 90,000. The middle number is the NRV of 85,000. You compare the 85,000 with the cost of 90,000. So the market 85,000 is less. That's the number you pick. And then E, 95,000 cost. Now, of the three choices, the replacement cost of 92,000 is the middle number, so that is the number you choose as your market. You compare the market of 92,000 with the cost of 95,000, so 92,000 is less. That's the number you pick as LCM. Now, you could do this a couple of different ways, just like you could with lower of cost or net realizable value, you can choose individual inventory items, you can choose categories, or you can choose total inventory. But in this case, let's say it's total inventory. You've got 387,000 as your lower of cost or market, whereas the cost was 415,000. So you're going to have a reduction, a write down in inventory of the difference between 415 minus 387, which is $28,000. And just like as before, how you write this down, the entries you make depends on how often you write down inventory. Again, if it's fairly common, then you debit cost of goods sold for 28,000 and credit inventory. If it's fairly uncommon, debit loss on write down of inventory and credit inventory. Again, you can do this by individual items. If so, then this is what it would look like. That would be the 387,000. If you did it by category, like we did with LCM NRV, then it would be 150 for the first category of totals A and B, or items A and B, and then for C, D, and E it would be 247,000. And then for total category, your market is going to be 402, whereas cost is going to be 415. So there you're going to have a write down of 13,000. If it was by category, it would be 18,000. So really, how you want to do this is up to management, because any of these are acceptable. Again, once you begin either by individual items, by category, or inventory, once you pick one of those options, you have to consistently apply them over periods in the future. All right, so next thing we want to talk about, and we'll do this in class on Monday, is Part B, Inventory Estimation Techniques. Part C, we'll talk a little bit about dollar value LIFO retail. And D, change in inventory method, as well as inventory errors. So we'll talk about those things on Monday.